Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies and they say, well, can these do it better?
Bitcoin's network has demonstrated extraordinary strength, attaining an all-time high hash rate of 679 exahash per second on September 7th, 2024, despite its price falling below $55,000. Such an outcome demonstrates the network's durability and stability, especially in light of the current Bitcoin price issues. Investment expert Lyn Alden, in her latest interview, attributes much of Bitcoin's durability to its decentralized network and strong security features, which are essential for supporting fast settlements. Lyn Alden emphasizes the significance of understanding who controls the ledger in order to avoid monetary devaluation, noting central banks' asset preferences, and developing countries' reliance on physical currencies. As Bitcoin grows, its decentralized ledger remains an important component of its attraction and potential for future growth and adoption. Lyn Alden also highlights how Bitcoin's capacity to deliver quick settlement has spawned the invention of dozens of alternative cryptocurrencies, all attempting to improve on its design and efficiency. Despite this, she agrees that Bitcoin is still a minor market compared to the global fiat money industry. Watch clips from the interview for further insights into Lyn Alden's conversation. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
Gold and silver have kind of like an inbuilt difficulty adjustment, which is that our technology gets better at finding them over time, but we've also mined a lot of the easiest deposits. So the deposits are getting harder, our technology is getting better, but we're not really increasing the supply too quickly. And if you look at gold over the past century, it's ranged between, and this is like World Gold Council data and US Geological Survey data. There's a couple different data sources you can look at, but gold supply is estimated to increase by 1% to 2% per year on average, and it's been a fairly tight band. You have to go back to the gold rush to find when we kind of meaningfully broke above that, and that was in large part because, again, an industrialized culture was coming to a continent that had not been industrialized yet, so they had a lot of low-hanging fruit to pick, kind of in terms of gold mining for at least a period of time. And so basically, through the process of iteration, societies came to see that gold and silver are the best ones. And the main reason why silver held its value is because gold's key limitation was divisibility. Even a small gold coin was worth more than most purchases. So silver was kind of the more daily use metal. And so this only became challenged in the telecommunication era because prior to telecommunications, speed didn't matter. All commodities kind of moved at the same speed. Things like coinage could help speed up the act of weighing and verifying a given commodity. But other than things like that, there wasn't really a big speed difference. But in the telecommunication era, we started to send, and that started in like the mid 1800s with the laying of the long distance telegraph cables. We started to do commerce at large distances very quickly, and so we started abstracting and paperizing everything, and we started kind of getting liftoff away from gold. And so it's kind of the first time we pivoted from a stronger commodity to a weaker commodity, kind of the dollar, like this ledger system it's actually less sound. We spent thousands of years always getting more and more sound, from shells to tobacco to silver to gold. And we kind of started reversing because speed was a new variable that mattered. So yeah, it's not an accident that humans settled on gold for so long. It's because it's the commodity with the highest stock to flow ratio. So how much exists compared to how much can be produced in a year. And so it's obviously got very good properties for how much value density you can store in it. How long it lasts when stored. Basically, it's not an accident that all of its properties line up to be good money, and then therefore it's used as good money. And so the way I put it in the book is that fast transactions are an easier problem to solve than fast settlements, right? So if you have Morse code and telegraph, you can do fast transactions. Two people can talk across the Atlantic Ocean and agree on a transaction. And then the settlement is the hard and slow part, sending and verifying gold. Even in the modern era, when Germany repatriated its gold, they expected it to take like 7 years, and they were happy that it only took like 4 years, which is it's kind of a comical number, and it costs millions and millions of dollars worth of logistics and security and auditing and all these things. Settlements have been a problem. One of the things I cover in the book is that Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies, and they say, well, can these do it better? Can someone find a way to hack it? Or how can it be updated over time to be more efficient? And all these things kind of happen, and it's still a very small market. It's only a trillion plus market cap in global fiat money is something like 100 trillion.
Lyn Alden suggests that while Bitcoin's decentralized ledger provides for quick transactions, sluggish settlements remain a concern. She observes that central banks value speed when keeping assets, preferring easily liquidated treasuries over gold due to logistical challenges. Individuals also prefer speedier value storage, such as the S&P 500 or real estate. However, Lyn Alden notes that these options may be unavailable in developing nations, where genuine dollars or gold are favored. She highlights the necessity of knowing who controls the ledger, since trust is critical for preventing monetary devaluation. She also addresses Egypt's structural money supply expansion, which results in a 20% yearly devaluation of the Egyptian pound, and how this impacts trust in the ledger. Let's go back to the interview and watch more clips to gain insights from Lyn Alden.
I think it's a very powerful solution, but it obviously takes time for the market to test it and adopt it. And so as long as we're still in this world where Bitcoin is small, fiat is big, we're still kind of in this weird limbo of, fast transactions, slow settlements. And one of the things you see is that both on an individual level and on a national level, they consider speed to be a variable. So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster. And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful. But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for example, and their local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Why is understanding who controls the ledger very important, Lyn?
Right. So we think of money, at the end of the day, it's kind of a ledger, right? In either the literal sense or the abstract sense. So, you mentioned barter, for example. An example I use in the book is that when I was a young engineer, we would often go out to lunch, like me and my coworkers would go out to lunch, and we kind of take turns driving And if someone at lunch doesn't have like enough cash on hand, back when people paid with cash more often, they would just say, "Hey, can you just cover this and I'll pay back tomorrow." Everybody kind of keeps track of this ledger of who's driving enough, who's not driving enough, who's who owes who money. A lot of things are just kind of solved by having this like mental ledger, this kind of informal mental ledger between us. And that's how a lot of hunter-gatherers do it as well. There's basically this kind of like family and kin type of arrangement. As things formalized, we started putting things into literal ledgers. And commodities also serve as kind of a nature-governed ledger. So if we, for example, trade around gold and silver coins with each other, we're using nature as a ledger. We're using the fact that nature has kind of this governing process on how hard is it to mine gold and silver? What do you have to do to get more of it? What are its properties? So we're kind of trusting nature that those properties are going to remain consistent. That sometimes is violated. Like in those other commodities, they were fairly consistent, but then new technology comes along and they can kind of cheat the ledger, at least compared to everyone else's technology. So far, gold and silver has been really resistant to that, which is why they're still monetary commodities. And so either whether trusting nature to run the ledger or trusting humans to run the ledger, we're in this environment where in order to not get our money diluted, we have to have some trust in the ledger that we're using. And in the modern fiat currency era, that's a trust that's commonly violated. So in Egypt, for example, I keep using Egypt because I live part of each year there. They've got over 20% structural money supply growth year over year. And so if you're holding Egyptian pounds, and many people still operate in a cash economy there, especially on the lower end of the income spectrum, it's not a heavily banked society. There's the middle class and up is generally banked. Some of them can earn interest on their bonds, things like that. A lot of the lower class is really just moving around cash, and they're storing cash as their savings. And this unit is getting diluted at 20% per year or more. And so they're kind of trusting a ledger that's getting kind of weaponized against them.
Lyn Alden highlights the significant advantage of Bitcoin's rapid settlement function in the financial sector. Unlike the slow and costly process of traditional gold settlements, Bitcoin enables confirmed transactions within minutes. This speed is made possible by its decentralized network, which ensures transaction finality unless a majority of miners vote to reverse it. Despite a recent drop in hash price to below $40, one of the lowest levels this year, miners remain committed to expanding their computational power. This determination has driven the network to new milestones, showcasing the resilience and dedication of Bitcoin miners. The recent surge in the hash rate underscores the strength of Bitcoin's decentralized architecture, where miners play a pivotal role in the network's continuous growth. According to Lyn Alden, grasping Bitcoin's unique characteristics is key to understanding its potential and significance in modern finance. Even as profitability declines, miners are focused on the long-term vision, pressing forward despite the risks. Bitcoin mining requires substantial financial investment and effort, and the recent increase in computational power, even in a challenging environment, reflects the miners' resolve to succeed. The network is now 67.9% of the way to the Zeta hash era, equivalent to 1,000 exahash per second, a remarkable feat given the current hash rate of 679 quintillion hashes per second. As Bitcoin's network continues to grow, a pressing question remains: how will miners adapt? Will they keep pushing the limits of computational power, driving the hash rate even higher? And what are your thoughts on how control of the ledger could reshape the balance of power between individuals, institutions, and governments in the financial system? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.